I'm Andrew. My group consists of Elena Macri, Paul Kohlenmeyer, and Jingyi Yu. So me and Jingyi are going to go over some management discussion and analysis areas of the annual report, as well as some issues related to financial statement presentation and formatting. And Paul and Elena will close out with some industry-specific issues related to the company's footnote disclosures. Okay, so first of all, for our analysis for the company's MD&A, Jingyi will cover some issues related to contractual obligations, and I'll be going over some areas related to operating segments.
One industry-specific area that we noticed in the MD&A section was contractual obligations. A majority of these contractual obligations are related to network programming for both television series and films. Additionally, the company specified obligations for creative talent and employment agreements and other purchase agreements stemming from advertising, marketing, distribution, and sponsorship obligations.
Okay, so the first area that stood out to us in the company's MD&A was about operating segments and how the Time Warner breaks its business down. Essentially, the company breaks its business down into 3 different segments, and these segments consist of networks, film and television entertainment, and publishing. We feel that this is an important distinction because this allows financial statement users such as investors and analysts to really get a good idea of where the revenues are coming from in each specific area of the business, and it allows them to further compare this information to the industry and other companies that operate in the entertainment industry. Even further than that, the company also breaks down the revenues into components, and there are 4 components, and these consist of subscriptions, advertising, content, and other. And so this provides another layer of detail for each segment of the business. They can break down each segment based on either of these 4 components to provide the most industry-specific detail possible for about their performance. Okay, so the first industry-specific financial statement presentation matter that stood out to us while we were looking over the company's annual report was the separate line item presented on the face of the balance sheet for inventories and theatrical film and television production costs. Essentially, this line item, it totals up all costs related to inventories held by the company for things such as DVDs, Blu-ray discs, and other types of merchandise. Additionally, theatrical film and television production costs that have been incurred for completed works and works that are currently in production are also included in this line item. So another way that we found this was industry specific is we found guidance under the codification in this code, which states that these costs for entertainment industry broadcasters are required to be presented separately on the face of the balance sheet, and Time Warner is obviously meeting those standards. Okay, so another area that we noticed for financial statement presentation matters was the way that Time Warner reports its revenues by component. And essentially the company breaks down its revenues into 4 components, which consist of subscriptions, advertising, content, and other. And even though other companies in different industries might report or break down the revenues like this into different components or areas. We feel that this is an important distinction for a company in the entertainment industry because it allows the financial statement users to evaluate the performance of each stream of revenue over time and compare this data to other companies in the entertainment industry. And I mean, overall, it's just much more informative for a company in this line of business rather than just having a single line item for sales revenue.
Another presentation error that we feel should be mentioned is the present note for commitments and the contingencies listed in the consolidated balance sheet. This is note 60 in the company's annual report and details the expected cash outflows. These industry-specific obligations result in a significant liability for Time Warner and are therefore given special consideration on the face of balance sheet and in the notes to the financial statements. Another matter of financial statement presentation that caught our attention was the fact that Time Warner specially details a line item for amortization to intangible asset on the consolidated statement of operations. Even though amortization of intangible assets is not specific only to the entertainment industry, we feel it is worth pointing this finding out because many companies recognize amortization costs related to intangible assets typically include other expenses. Therefore, we feel that it deserves to be pointed out because it's such an important aspect of Time Warner's financial report.
Now we're going to talk about Time Warner's footnote disclosures that we have identified to be industry specific. We identified 6 of them, and the first one is theatrical film and television production costs. Next is film library. The next one is programming licensing backlog, party transactions, accounting for collaborative arrangements, and gross versus net revenue recognition. The first industry-specific disclosure that we notice in the annual report relates to the composition of theatrical, film, and television production costs. Those costs are divided into 4 categories. The first one is release less amortization. The second one is completed and non-released. The next one is in production, and the last one is development and pre-production. According to the ASC 926-20-50-2, it says that entities are required to disclose those components of film costs separately for theatrical films and direct-to-television product. In the same disclosure, we also noted that the company discloses the percentage of unamortized cost and also the expected number the theaters and the television product is going to be amortized. According to the ASC 926-20-50-3, it says that companies that expect to amortize film costs for released films within 3 years from the date of the balance sheet, they should disclose the percentage of unamortized cost in their notes. Lastly, in the same disclosure, we also noted that the company disclosed the amount of film cost for released and completed and not released for theatrical and television product that are going to be amortized within the 12-month period ending at the balance sheet date. Again, this is a requirement by ASC 926-20-50 that says that the company should report the cost of completed films that expects to amortize within a 12-month period. The other industry-specific disclosure that we identify in the annual report is the classification of film library. An acquired film library is not classified as non-current asset like the theatrical film and the television production cost. It's actually categorized as an intangible asset. Although all intangible assets are amortized using the straight line method, film library uses the film forecast methodology, the same method as the theatrical film and the television production cost uses. The other disclosure that we identified to be unique for the entertainment industry is programming licensing backlog. This was found under the commitment and contingency note. As explained in the disclosure, backlog is completed licensing agreements that the company has not recorded any revenue until the telecast period starts according to the agreement. According to the ASC 920-440-50-1, it says that completed licensing agreements should not be recorded as a liability, but they should be disclosed as a commitment by the broadcaster if it does not meet the 3 criteria for licensing agreement. The 3 licensing agreement criteria are as follows. The first one is the cost of each program is known or it's reasonably determinable. The licensee accepts the program. And lastly, the program is available for its first showing and telecast.
Looking at Time Warner's annual reports, we also found barter transactions to be an important aspect of overall business and a big portion. Barter transactions refers to non-monetary exchanges where Time Warner exchanges advertising revenues for other products or services such as programming and licensing fees. While barter transactions might not be quite unique to the entertainment industry, Time Warner it's a big portion of Time Warner's overall revenue, and we felt that it was important to point out. Another interesting area we found in the financial statements of Time Warner is accounting for collaborative arrangements. Collaborative arrangements refers to arrangement that Time Warner enters with third parties to jointly finance theatrical production and distribution of a film. While this type of arrangement is not industry specific, co-financing arrangements are among various industries. However, the treatment of this arrangement is quite unique to the entertainment industry. The TV and entertainment segment records the amount as a reduction of the cost of the film. And so based on this, Time Warner either reflects a charge or a benefit to the cost of the revenue in the consolidated statement of the operations. Further looking into the footnotes, we also identified the area that discusses revenue recognition and how to account for gross revenue versus net revenue. This area has become increasingly complex for organizations in the entertainment industry because the difference depends largely on the judgment of the company. And according to Time Warner footnotes, they record revenue on a gross basis if they act as the principal, and they will record on a net basis if they're acting as an agent. And they also mentioned that they will make that determination based on their judgment and assessment, which usually relates to the contractual agreement of the transaction. So in our presentation, we discussed industry-specific factors that we felt were important and unique to the entertainment industry. We discussed some of the things that we found in MD&A, the presentation, the format of the financial statements, as well as the footnote disclosures that Time Warner shares with its shareholders and investors to better help us make those investment decisions. We hope you enjoyed our presentation, and we thank you for your time.